like to acknowledge the traditional owners whose lands on which we meet today and pay respects to their elders past, present and emerging. It's been some time since we've been able to welcome international visitors back to our shores, so I'm thrilled to be joined by two of our senior leaders. I think you'd be hard-pressed to find two more qualified people to discuss the questions that we've got coming through today. Firstly, Greg Davis is Vanguard's Chief Investment Officer, overseeing Vanguard's fixed income, equity index and quantitative equity groups. Previously, Greg was Principal and Global Head of Fixed Income and also served as Asia Pacific Chief Investment Officer and Director of Vanguard's Investments Australia. Welcome back, Greg.
It's great to be back. I love Australia.
Joe Davis is Vanguard's Global Chief Economist and Global Head of our Investment Strategy Group, whose research and client-facing team develops asset allocation strategies and conducts research on capital markets, the global economy, and Joe also chairs the Strategic Asset Allocation Committee for Multi-Asset Class Solutions. Welcome back, Joe.
Oh, great to be back. Thank you.
Okay, so one of the questions we've been getting is, are we near the bottom for both equity and bond markets? Because it's been a rocky start to 2022. What are the paths to recovery and risk to each? And I guess, the improvement in outlook that we've seen potentially from that contraction.
It's a really good question. So, it's very challenging to understand and figure out exactly where the bottom is. We know there's been a significant correction when it comes to the global equity markets. We've also seen one of the worst starts that we've seen in the history of the bond market, the worst start since 1788. So we've seen both stocks and bonds being pressured this year. There's been a tremendous amount of activity from a variety of central banks around the globe as they're starting to tighten financial conditions. So again, we feel like there's a lot of repricing that's already occurred. In terms of figuring out whether or not this is the absolute bottom, nobody can really tell you that. What we would say is that when we look at valuations from the equity perspective, we still think that equities are still slightly overvalued relative to some of their historical trends and data. When you look at the fixed income markets, whether or not it's investment grade bonds, high yield bonds, emerging markets, those things have cheapened up substantially, but they're not fully pricing in the risk of a recession on a global basis. So things have cheapened up. They're much cheaper than they were 6 months ago, 12 months ago. But there's still a risk that if there is a recession that happens, whether or not it happens in the US or from a global basis, that's not fully reflected in asset prices. So there's still some risk from that component as well.
Okay, great. Joe, we know you love your history, and we couldn't get through one of these sessions without asking a question about inflation. So I guess in the 1970s, we obviously saw a lot of inflation. We touched on that earlier in the year in our VMO. But we haven't really had a period where we've had central banks also have inflation targeting, because that was introduced in the 90s. So what lessons do you think we can learn from history?
Well, I think the lessons we could learn is something that I think we're seeing central banks more fully appreciate than perhaps they were doing a year or two ago. So like the 1970s, there's both a lack of supply, as well as just strong demand driving inflation up. And the inflation run-up has taken us by surprise, even though we were concerned about the inflation pressures building. And I think it'd be fair to say the entire markets have been somewhat surprised. I think what is comforting that history shows is that the supply shocks, although they are very painful, they can lead to recessionary risk. They ultimately start to peter out. What we have really focused on is on the demand side. And so I think the lessons in the 1970s are that the central banks have to focus on the labor market, focus on wage pressures, because it's the wage pressures that ultimately determine how sustainable and persistent those inflationary pressures are, whether they're for food or energy, whatever's going on in the world. And so I think what we are seeing is a greater appreciation, whether it's the RBA or the Federal Reserve or the Bank of England, despite the challenges of weaker growth from the food and energy tax, so to speak, that you really have to stabilize and lower the wage pressures, which means be more restrictive. And so I think what we're continuing to see, we have long said that the central banks potentially would be more aggressive than the bond markets were expecting. I think it's some of the catalysts that Greg mentioned about the volatility. Longer term, this is good news for investors, because the worst thing that investors we could see is actually what I don't think we will see, which is a sustained multi-year period of high inflation that continues to lead to bond market losses. I think those are low odds, but that's in part because we're going to see greater tightening than even potential the central banks potentially right now anticipate. So I think ultimately this is good news, but that will be a source of volatility for the next 12 or 18 months.
Some investors, I guess, are a little bit jittery about the current volatility and just concerned about whether they should be investing now and see this as an opportunity to get into the markets, or whether they should be staging their approach, like a dollar cost averaging approach. What does Vanguard think?
I think it's always challenging for investors to think about point in time what they're going to do at that exact moment. Dollar cost averaging historically has worked out pretty well for most investors. The thing what you want to do is you do want to get fully invested, because there's always the risk that if you wait too long, and we have some data from Joe's team that talks about if you miss the 30 best days in the equity markets, and you go back, the data goes back to 1928, if you miss the 30 best days in the equity market returns, and they tend to come after the worst points in time in history, you're likely to have an annualized return that's almost 300 basis points lower than had you been invested over the entire time. So, again, we want to make sure that investors get invested to whatever their appropriate allocation is, and you want to get there eventually sooner rather than later, because timing is unbelievably difficult for investors to get that right.
And I just want to underscore what Greg said, because I found that result actually fascinating, is that 300 basis points, that is half of what historically has been the outperformance of stocks versus, say, sitting in cash in any market in the world. So half of that, what Greg just said, in 30 days, which is usually the turning points, which is precisely what, if I'm an investor sitting on the sidelines, that's what I'm waiting to see to calm down so I can put my mind to work. Well, then I just missed.
That's right.
Half of the equity market performance. So the risk is that investors longer term turn a stock market investment to more of a fixed income investment in terms of returns. And so I just thought that was a fascinating result. It underscores our longer term perspective.
And I guess just on the strategic asset allocation approach that we adopt in our diversified funds, particularly in the funds that we offer in the Australian market, those have come under a little bit of pressure throughout the first part of 2022. Do we still think the strategic asset allocation approach is the best way to go?
Well, certainly. And again, we're not going to ignore the fact that the volatility we saw, or the underperformance and total return losses in fixed income and equity markets were pretty significant, and they were compressed in a short amount of time. We have seen that. It's not unprecedented. We've seen that in periods where inflation is much higher than expected right now. But we look at the principles of asset allocation over longer periods of time. Bonds outperform cash because of the risk of locking in one's money into our longer-term financial instrument. And so it is very clear from us and history, as well as any forward look at expectations, that stocks will outperform bonds because of the risk and the principal risk, and bonds will outperform cash. And that's a central ingredient and tenet of our investing approach. That does not mean, however, there will not be periods of negative returns. But the pairing of those two asset classes is actually very powerful. And so we always come back to that, but it's not because we don't test it and rigorous in our simulations and our estimates. Again, we come back to that, and Greg is part of that asset allocation committee, and we recently were talking about that again this year. It's our responsibility to always look at the research and to stress test it, but we ultimately come back to that pairing of those two important asset classes.
To Joe's point, the strategic asset allocation makes complete sense for the long run. The challenge you run into with tactical asset allocation is you're, again, trying to time the market. And historically, that's been very difficult even for professional investors to do. So it's really important for folks to set their strategic asset allocation based upon the risk level they want in a portfolio, how much volatility they're going to be willing to bear, and that they're going to be willing to stick to when there is a downturn in the market, because that's always the biggest thing to take into consideration. You don't want to do something in a portfolio that's going to be harmful in the long run because you couldn't take the short-term drawdowns that might occur. And we know having a strategic asset allocation, whether or not that's 90-10 or 70-30 or 50-50, depending upon the investor's risk tolerance, you just want a tolerance that's going to allow them to weather even the bad periods in the marketplaces. And we know they come up every few years.
Thanks for joining us today, and thanks to our visitors for making the time to come to Australia and support our market here. Thanks for joining us.
Great being here. Thanks so much, Lou.
Our pleasure.